Imagine waking up one morning, opening your banking app and seeing this: account closed. No call, no warning, no explanation, just gone, your money frozen, your access cut off. This is happening to seniors right now, all across the country, and most of them never saw it coming. Today, I'm going to show you exactly why banks are doing this, and how you can protect yourself before it happens to you. Here's something you need to understand right away. Banks are not closing senior accounts randomly. There is always a reason. Sometimes it's something small, something you didn't even think mattered. Sometimes it's a policy change happening quietly behind the scenes, something you'd never even hear about unless someone told you. Over the past few years, banks have gotten a lot stricter. New rules, new software, new risk management systems that flag accounts automatically, sometimes without a single human being even looking at your file. And here's the hard truth: seniors get flagged more often than younger customers. Not because they're doing anything wrong, but because of how they use their accounts, how often they check them, and how outdated some of their information can get over the years. The good news is this: once you know the reasons banks use to close accounts, you can avoid every single one of them. That's exactly what we're going to walk through together, step by step, so by the end of this video, you'll feel confident and in control of your money again. Let's start with the most common reason of all. The first reason banks close accounts is something called dormancy. In plain English, that just means the account hasn't been used in a while. Now, how long is a while? It depends on the bank, but usually it's somewhere between 12 months and 3 years without any activity. That means no deposits, no withdrawals, no transfers, nothing. And here's the part that surprises people: just checking your balance online usually doesn't count as activity. The bank wants to see real transactions. Let me give you an example. Say you opened a savings account years ago. Maybe it was for an emergency fund, or maybe a family member set it up for you and you just never touched it. If that money sits there, untouched, for a couple of years, the bank starts to treat it differently. First, they might mark it inactive. Then, they might mark it dormant. And after that, in many states, the bank is actually required by law to hand that money over to the state government under something called unclaimed property laws. This catches so many seniors off guard because they think, it's my money, I'll get to it eventually. But banks don't wait. If they don't see activity, they start the clock ticking. And once that account goes dormant, getting your own money back can mean paperwork, phone calls, and sometimes even proving your identity all over again just to access funds that were yours the whole time. The simple fix here is this: keep every account you own active. Even a small deposit or withdrawal every few months is usually enough to keep the account in good standing. If you have an old account you forgot about, this is your reminder to check it today. The second reason is one that catches a lot of good, honest people by surprise: unusual transaction activity. Banks have automated systems that watch every account for patterns that look different from your normal behavior. If you suddenly withdraw a large amount of cash, send money overseas, or receive a big deposit from someone the bank doesn't recognize, that can trigger a red flag. And once that flag goes up, the bank can freeze the account first and ask questions later. Now here's why this hits seniors especially hard. Banks are required by law to watch closely for signs of elder financial abuse. This is actually a good thing in many cases. It protects seniors from scammers who try to drain their accounts. But the tricky part is, the system doesn't always know the difference between a scam and a normal, legitimate transaction. For example, let's say you're helping your grandson with a down payment on his first car, and you send him a large chunk of money in one transfer. To you, that's a loving, generous gift. But to the bank's fraud detection system, that can look exactly like a scam pattern: a large, unexpected transfer to someone the bank doesn't recognize as a regular contact. Or maybe you're selling a family heirloom or an old car, and someone pays you in a large lump sum through a wire transfer. Again, totally normal in real life, but flagged instantly by automated banking software. When these systems trigger a flag, here's what usually happens. The bank places a temporary hold on the account. Sometimes they call you to verify the transaction. But if they can't reach you, maybe because your phone number on file is outdated, which we'll talk about soon, the hold can turn into a freeze, and the freeze can eventually turn into a full account closure if it's not resolved. So what can you do? If you know you're about to make an unusual transaction, a big transfer, a large withdrawal, sending money to someone new, call your bank ahead of time and tell them what's coming. It sounds simple, but this one habit alone can prevent almost every unnecessary freeze or closure. The third reason is one that sneaks up on people slowly, over months, sometimes even years, falling below the minimum balance requirement. Many checking and savings accounts require you to keep a certain amount of money in the account at all times. If your balance drops below that amount, the bank charges a monthly fee. That fee might only be $10 or $15, but here's the problem. If you don't notice it, that fee comes out every single month. Let's walk through how this plays out in real life. Say your account requires a $500 minimum balance to avoid fees. Over time, maybe your balance drops to $400 because of some unexpected expenses. Now you're being charged a monthly fee. If you don't catch it and correct it, that fee keeps chipping away at your balance every month. Eventually, the account can hit zero. And once an account sits at zero for a certain period of time, many banks will automatically close it. The frustrating part is, this can happen very quietly. You might not even realize your balance has dropped below the required minimum until you get a letter, or worse, until the account is already closed. Here's the simple solution. Check your bank's minimum balance requirement today. It's usually listed in your account agreement, or you can call and ask directly. If your balance is close to that number, consider moving a little extra money in as a buffer. And if your bank offers text or email alerts for low balances, turn those on. That one small step can save you from months of quiet fees eating away at your account. Now let's talk about reason number 4, and this one might be the sneakiest of them all: outdated personal information. Think about how long you've had your bank account. 5 years, 10, 20. Over that time, how many times have you moved? How many times have you changed your phone number? Is the email address on file even when you still check? Banks are required to stay in contact with you. It's part of their regulatory responsibility. So when they send out important notices, updates about your account, requests to verify your identity, or warnings about unusual activity, they send them to whatever address, phone number, or email they have on file. If that information is outdated, here's what happens. The bank sends a letter, and it comes back marked "Return to Sender." Or they try to call, and the number is disconnected. Or they send an email, and it bounces back undelivered. After a few failed attempts to reach you, many banks will flag the account as unreachable. And an account they can't verify is an account they see as risky. This becomes especially serious if your identification is expired too. Every few years, banks are required to re-verify their customers' identities to comply with banking regulations. If your driver's license or state ID has expired, and the bank can't confirm your current identity, that can be enough to trigger a freeze or even a closure, especially if it happens at the same time as an unusual transaction or a period of inactivity. Here's what you need to do right now today, not next week. Log into your account or call your bank and confirm 3 things: your current address, your current phone number, and your current email. Then check the expiration date on the ID you have on file with the bank. If anything is outdated, update it immediately. This takes maybe 10 minutes, and it can prevent a huge headache down the road. The fifth reason is a difficult one to talk about, but it's incredibly important, especially for couples or families who share accounts. What happens when a joint account holder passes away or becomes incapacitated? Many seniors share a bank account with a spouse, a sibling, or an adult child. It makes life easier, bills get paid, money moves back and forth without hassle. But when one of the account holders passes away or becomes unable to manage their affairs due to illness, the bank has to follow strict legal procedures. Here's what often happens. As soon as the bank is notified of a death, sometimes through a death certificate, sometimes just through information they receive from other sources, they may freeze the account temporarily. This is done to protect the account from unauthorized access, while the bank sorts out who legally has the right to the funds. If the account was a joint tenancy account, meaning both names were on it with rights of survivorship, the surviving account holder usually keeps access, though the bank may still ask for documentation like a death certificate to update their records. But if the account structure was different, for example, if it technically belonged to one person with the other listed as a beneficiary rather than a joint owner, the account can be frozen entirely until the estate is settled through probate, which can take months. Something similar happens if an account holder becomes incapacitated, meaning they're no longer mentally able to manage their own finances due to a health condition like advanced dementia or a serious medical event. In these cases, whoever is left as the co-owner or authorized user might suddenly find they can't access funds the way they used to, especially if the bank requires legal documentation like a power of attorney. This is why it's so important to have your paperwork in order before anything happens. If you share an account with a loved one, know exactly how that account is structured. Is it joint with rights of survivorship or something else? Do you have a power of attorney set up in case of incapacity? These documents don't just protect your family emotionally during a hard time, they protect your access to your own money. Now here's a reason that has nothing to do with anything you did. Sometimes the bank itself changes the rules. Banks regularly review their own risk policies. This might mean they decide certain types of accounts are no longer profitable for them to offer. It might mean they've been acquired by another, bigger bank, and they're closing out old account types that don't fit the new system. Or it could mean new regulations came down from the government, and the bank has to adjust who they can serve and how. When this happens, banks sometimes send out closure notices to entire groups of customers at once. This can feel very personal and very scary if you're on the receiving end, but often it truly is just a business decision that applies to hundreds or even thousands of accounts, not something targeted at you individually. For example, some banks have reduced or eliminated certain checking account types that were popular with retirees because they weren't generating enough revenue for the bank. Other times, a smaller regional bank gets bought out by a larger national bank, and certain account types simply don't exist anymore under the new ownership. So customers are given a notice period to move their money or convert to a new account type. The key thing to understand here is that these letters are usually sent well in advance, often 60 or 90 days before anything actually happens. That means if you open your mail regularly and read these notices carefully instead of setting them aside, you'll have plenty of time to respond, ask questions, or move your funds to a new account without any disruption at all. Now that we've covered the main reasons banks close accounts, let's talk about something incredibly important: the warning signs that almost always come before a full closure. Banks rarely close an account with zero warning. In almost every case, there's a paper trail leading up to it. The problem is, these warnings are easy to miss, especially if you're not looking for them. The first sign is usually a letter in the mail. Banks are required to notify customers before certain actions, and this notice often gets mixed in with junk mail, or it gets set aside to deal with later, and then forgotten. The second sign is often a temporary hold or restriction on the account. Maybe you try to make a withdrawal and it's declined, or you notice a portion of your funds are marked as unavailable. This is often the bank's way of pausing things while they investigate something, whether that's a large transaction, outdated information, or a compliance check. The third sign is usually a request for verification. This might be a phone call asking you to confirm your identity, or a letter asking you to bring updated identification into a branch. If this request goes unanswered for too long, it often leads directly to a closure. The fourth sign is a noticeable change in how you can use your account. Maybe your debit card suddenly stops working, or you can't log into your online banking app anymore. These are often the final steps before an account is officially shut down. Here's my advice. Open your mail. All of it, even the pieces that look boring or routine. Check your bank statements every single month, not just when something feels wrong. And if you ever get a call, letter, or email from your bank that requires action, don't put it off. Handle it that same week if you can. This one habit alone can be the difference between catching a problem early and losing access to your money completely. But let's say it already happened. Maybe you're watching this video because your account was already closed and you're wondering what to do next. Don't panic. There is a path forward and I'm going to walk you through it right now. The first step is to contact the bank directly and ask for the specific reason your account was closed. Banks are required to provide this information if you ask, even though they may not have stated it clearly in their original notice. Get this in writing if possible, either through an email or a formal letter. The second step is to find out what happened to your money. In almost every case, your funds do not simply disappear. If the account had a positive balance when it closed, the bank is required to return that money to you, usually in the form of a check mailed to the address on file. This is exactly why keeping your address updated is so important. If the check gets mailed to an old address, it can take weeks or months of extra paperwork to track it down. If you never receive that check, or if you believe there was money left in the account that hasn't been returned, you can file a complaint with the Consumer Financial Protection Bureau, often referred to as the CFPB. This is a government agency designed specifically to help people resolve issues with banks, and they take these complaints seriously, especially when the situation involves an older adult who may need extra support navigating the process. The third step is figuring out your banking situation moving forward. If your account was closed due to a policy change or dormancy, you may simply need to open a new account, either at the same bank or a different one. If it was closed due to something like a flagged transaction or an identity verification issue, you may need to provide additional documentation before you're allowed to open a new account there. And here's an important note. If your account was closed due to suspected fraud or a compliance issue, it's possible that information gets reported to a specialized database that other banks check when you try to open new accounts. This doesn't mean you did anything wrong, but it does mean you may need to be prepared to explain the situation clearly and calmly to a new bank, and possibly provide documentation showing the issue was resolved. Throughout this whole process, patience is your best friend. These situations can take weeks to fully resolve, and it can feel incredibly frustrating, especially when it's your own hard-earned money on the line. But by following these steps calmly and keeping records of every phone call, letter, and email, you put yourself in the strongest possible position to get everything resolved quickly and fairly. Now that you understand why accounts get closed and what to do if it happens, let's finish with the most important part: how to make sure this never happens to you in the first place. First, use your accounts regularly. Even small, Simple transactions once a month can keep your account active and in good standing. If you have an old account you rarely touch, set a reminder to log in or make a small transaction every few weeks. Second, keep your personal information updated. Your address, your phone number, your email, and your identification should all be current with every single bank you work with. Make this a habit you check once or twice a year, maybe when you're doing your taxes or reviewing your finances at the start of a new year. Third, watch your balance and avoid unnecessary fees. Know your bank's minimum balance requirements and set up alerts if your balance drops close to that number. A simple text alert can save you from months of quiet fees you never noticed. Fourth, communicate with your bank before large or unusual transactions. If you're sending a big gift, making a large purchase, or receiving an unexpected deposit, a quick phone call to your bank ahead of time can prevent an unnecessary freeze or flag. Fifth, if you share accounts with a spouse or family member, make sure your legal paperwork is in order. Know how your accounts are structured, keep power of attorney documents updated, and have honest conversations with your family about what should happen to your accounts in case of an emergency. And finally, open your mail and read your statements. This might sound like such a small thing, but it truly is the single most powerful habit you can build. Banks almost always give warning before taking serious action, and that warning usually comes through the mail or through your account statements. If you make it a habit to read through these regularly, you'll catch problems while they're still small and easy to fix. Your money represents years of hard work, careful saving, and planning for your future. You deserve to feel secure and in control of it, not caught off guard by rules and systems that most people never even hear about until it's too late. By staying informed, staying active on your accounts, and keeping your information up to date, you put yourself in the strongest possible position to keep every dollar exactly where it belongs, safely in your hands, under your control.